Hello, my name is David Stevenson,
And my name is Paul Cuatrecasas.
and together we're the founders of Future Food Finance. Um, we thought we'd talk a little bit this episode. We're not going to talk about what's happening in the wider food tech sector. We are going to talk a little bit what's happening in the wider venture capital markets, um, because I think probably the most interesting story at the moment for investors in the whole kind of food tech space is figuring out whether or not we are at the beginning, in the middle, or towards the end of a journey in which kind of venture capital valuations get slashed. Um, I saw an amazing statistic recently which said something like only about 5 or 10% of VC rounds have been a down round yet. And that got me thinking, and then I'll get your thoughts on this, Paul. I did a piece actually on my own newsletter over at davidstevenson.substack. How we could put a yardstick about how long it takes and how big the falls are before we get to a sensible valuation. And we're beginning to see, actually, from the public markets, because there are some listed venture capital firms out there, and they have to disclose stuff. They've got regulatory news requirements, so you do find out what's going on, yeah? So these are publicly listed VCs. You find out what's been going on with valuations. And I thought it was two useful yardsticks to kick off the conversation. Was one, there was in the fintech space, very well-known brand called Klarna, which is excellent brand actually. You probably run into the buy now pay later kind of business. And basically, if we do the maths from the beginning of the year or towards the end of last year, so this is end 21, beginning 22, to the point where we are now, you get to basically an 85%, yep, 85% decline in valuation. Yeah. Now that's a late stage business, okay? But that doesn't sound wrong actually, because if we look at, for instance, Kathy Woods, she's got her ARK Invest, ARK Innovation ETFs, and they're invested in publicly quoted companies. And you look at how much that ETF has gone down since the beginning of this year. So again, from January 2nd onwards. So 85% for Klarna. Kathy Woods' kind of high tech businesses, very disruptive, have gone down by 60%, okay, on average. And, you know, the NASDAQ is down 30%, yeah, so you'd expect smaller cap businesses to probably have gone down by more than 30% if NASDAQ's gone down by 30%. So if smaller cap tech companies, these are quoted companies, earlier stage companies, have gone down on average by about 60%, Klarna, late stage companies, gone down by 85%. I don't think it's unreasonable to turn around and say, well, actually, whatever you're seeing in any, for instance, listed VC book at the moment, you could probably knock 80 to 90% off the valuation. But then I'll finish. And I think that there may be some exceptions to that rule. There may be some bits of the market where the valuations are not so drastic. So I think it probably is the case of fintech, for instance. I think it probably is the case actually for things like delivery firms, probably is the case. Things may be the case for things like alternative proteins, up for debate. But one thing I have picked up from the markets is some smaller niches, particularly where there's a weight of money coming in, yeah, a huge weight of money coming in, and not many opportunities, yeah. Then actually those declines cannot be as great. And I have a feeling at the moment that's all it is, that actually ag tech, yeah, that may be the case. Still a very, very small bit of the VC market. It's a tiny bit of the market, yeah. There's a lot of money coming in because people are waking up. And so therefore we might not, in that sector, see 80 to 90% red marks all over the portfolio. But anyway, Paul, that's my thesis. Very difficult to prove because you can't always get the valuations. What's your sense of that?
Well, David, I think everything is relative. And that means every company is different, just like every person is different.
Yeah.
And we've got to be careful making generalizations. I think
Yeah.
clearly valuations are down for any startup company that is either not generating revenue or losing money and needs to raise money to support a cash burn to get to self-sufficiency. No doubt about that. But let me give you an example of what I mean by every company's relative, certainly in the private financing market. So I had a call yesterday with a founder CEO of, guess what, an online grocery delivery company in the UK. And you think, well, why would a company start now, especially a company that's going to need cash to finance a road of maybe 12 to 18 months of cash burn? after we've seen DoorDash, as an example, being down 75% or so in the last year. I think Deliveroo is also down. I mean, they're all more or less down between 60 to 80% in the last
Yeah.
year
Yeah.
on the delivery side. And then, of course, if we talk about plant-based, that's down, Beyond Meat is down 80%, 85% in the last year. So why do that? Well, his view was, I've been an executive at these types of companies, and I am very aware of all of the problems these companies have had. I'm very aware of the financing markets. I'm very aware that investors today are demanding either profits or they're demanding a very clear path, i.e., low risk of not making it to profitability soon, very high probability of profits, i.e., the following 10 things can go wrong, or we can be behind by 6, 12 months. We'll still be profitable, and here's how.
Yeah.
And I think that's the key. So if you have raised or have tried to raise, you've raised money in the last year, 2, 3 years, for sure, you're going to have some adjustments. But if you're just starting up now, or you're going to market, the financing market, private financing markets, and you're confident, very confident of your ability to get to profit, then you can raise money, and you can raise money at a fair valuation, fair price, maybe rather than some of the prices we saw a year ago.
So, does that mean, therefore, that for some of the earlier stage companies, because a lot of the companies I've been talking about are much later stage, yeah? So, Klarna was looking at doing an IPO. So to be fair, I was looking at later stage private companies.
So just on that, David, later stage would include Beyond Meat, which is down 85%.
Yeah.
Robinhood, Coinbase, Deliveroo, Just Eat, DoorDash, even HelloFresh. I mean, we could go down the list of companies that are late stage, that are generating significant revenue, and in some cases generating profit, and they're down.
Yeah.
And why? Well, that's a simple one, really. That's a direct result of higher interest rates, which, when applied to future cash flows, which for all of these companies are projected to be much higher, 3, 5, 10 years out, guess what? When you discount them back to today, present value, it's a lot smaller. So that's a very simple equation, I think, and certainly with anticipated interest rate rises on the horizon, I think almost everybody agrees that's what we're looking at. We can't expect those prices to rise in any significant way anytime soon. So I don't know if that helps frame the late stage versus early stage.
On the early stage, when do you think, I mean, none of us know the answer to this, so let's put our hands up now, yeah? When do you think we're going to see two things happen? One, some quite big kind of red pens all over early stage valuations, yeah? Or do you think that will happen at all? Yeah.
It's already started.
Okay.
It's already on that one, David. I think it's already happening. Now, what's interesting is when we start seeing some announcements of companies that haven't been able to raise the money that they need to raise to survive, and they either fold or they get sold for a penny. I mean, we saw some of this in the last year, with some weak sectors like delivery, but we haven't seen any big ones fall yet. So that's going to be interesting. So the red pens are out. Okay. They're out everywhere, and you don't always read about it. This is a private market, so you're not going to know. Even if you do read about it, it doesn't mean it's true. I mean, you know better than anyone, David. You can't believe the headline of any article or press release. It's devil in the details. So it's going on. It's everywhere at the moment. I think whatever we read about, well, valuations haven't had the adjustment in the private markets yet, that's true to a certain extent because there's always a lag. But at the end of the day, it boils down to the founding shareholders and their venture investors, early investors, accepting that valuations have changed. Yeah. And there's always time. Time is required for that to sink in. And then when they start to realize that investors are not showing the same love as they did, 6 months ago or a year ago, then they have to make course corrections. They've got to adjust. So the red pens are out.
And the last point about ag tech, that was based on a couple of conversations I've had with people, um, and that's sort of based upon a slightly different theory about weight of money, actually. Yeah, which is if you look at where private funding's happening, it's quite often very concentrated in sectors that we all know about. Yeah, so fintech's had a lot of money gone into it, flooded into it. Uh, Food delivery, you mentioned, has had a lot of money come into it. In the last couple of years, alternative proteins, a lot of money come into it. My perception is there are certain niches, and ag tech is one of them. I suppose you could look at things like quantum computing, might be another area, completely different area. Synthetic biology might be another area closer to this, where there's not actually a lot of companies in the great schema of things. Yeah, there aren't thousands of companies that are ideas and startups out there. Partly because quite often the barriers to entry are quite high in the food tech market. You've got to develop some technology that works with all farmers, quite often quite expensive, and it's still in the early stages of that revolution. But because there aren't a lot of companies and there's quite a weight of money beginning to build up, you could get these kind of abnormalities in the market where niches, they don't see quite the same cold freeze, cold snap that happens in kind of e-commerce or food delivery. What's your sense in? I mean, it's very difficult to know this because it's such a niche market. There's not a lot of players in it. It's based upon a handful of reports back. But my sense is that agtech may well survive winter.
Well, ag tech as a category is massive, gigantic. It's global. There's
In
agriculture
opportunity, yeah,
in opportunity for sure. Just as there is in food tech, it's just different. In ag tech, it's global, so you've got farms everywhere, and all those farms are using technologies in different ways for their entire value chain.
yeah,
And David, you and I were talking earlier today, even about this company, I think in Finland, that has developed the vertical farm technology for growing trees. So
yeah,
grow the saplings in a vertical farm as
yeah,
opposed to growing them from seeds,
yeah,
because the probability of those trees surviving
yeah,
and the yield probability is so much higher that they said, yeah, we're going to grow in vertical farms. And I think it's a brilliant idea and could be exported all over the world and is leveraging technology that was certainly, if not originally, then intended in the early days for
fresh
vegetables,
food,
leafy
yeah,
greens and like.
yeah, yeah.
So I think this is the point about the beauty of technology is that you never know where it's going to go. You know, you never know what new
Yeah, that's a
technology
good point.
is going to solve an existing problem. For example, I was reading today, and this isn't ag tech, but you could argue that farming fish is effectively a form of agriculture. But I was reading
Yeah,
today that
aquaculture, yeah,
yeah, aquaculture. I was reading that Blue Nalu, the San Diego company that's
yeah,
developing cultured fish, great management team, great company. The Lou Cooper House, the CEO, was suggesting that they should be comfortably making gross margins of 75%, which
wow,
is a pretty high gross margin for tuna, for fish. And you think, well, wow, that's exciting. They've been talking with the FDA for 3 years about regulatory approval, and maybe they get it next year, maybe it's the following year. But that's exciting. And if you can make tuna in bioreactors, which they're planning, I think 100,000 liter size bioreactors, that's pretty exciting. That sounds like a great business. The catch is that they don't expect, as I was reading, they don't expect to begin production in the commercial facility until 2027.
yeah,
And that is a long time by the measure of most investors.
yeah,
Now, it's not a long time if you're a university or an academic institution, but for most investors, that's a very long time. And we all know that time creates possibility. So yes, during that time period, there might be new technologies that allow that cost to come down even lower, or maybe they find a way to produce more with a smaller bioreactor or maybe a lower cost bioreactor. But it also creates Murphy's Law opportunity. Things can go wrong and they can take even longer.
yeah,
And that's really the challenge. And I think this is the essence of startups. How long can investors wait versus a large corporate, which in-house might have something percolating for years? And I use the example of GM, the automaker, acquiring Cruise Automation in 2016 for $600 million cash. Now, Cruise had zero revenue at the time. So what was GM thinking? GM's a publicly listed company, price earnings ratio, cash flow. 600 million isn't token money. It's significant. It's material. What are they thinking? Well, they had the benefit of being able to go out 10 years. So it wasn't a $20 billion acquisition, which would have been 30, 40, 50% of its market cap. It was a relatively small acquisition. They could say to their investors, look, self-driving technology is going to happen. It's 100% dead certainty. The only question is when. It's not imminent. It's at least 5 years, if not 10 years, maybe 20 years out. But we want to be a leader because it's inevitable. We have to be a leader. We can't do it all in-house, so we're going to acquire the very best company. And we know that that 600 million over time, in 10 years' time, will be worth 6 billion or 60 billion or more. And that is more doable, comfortable for a large corporate to make on a 10-year basis than a pure startup to say, we need money for the next 10 years because our product won't be commercial. We won't be generating free cash flow for another 10 years. Now, that ultimately is what happens with most startups. It does take them 10 years before they get to free cash flow. But if you're starting out saying, look, we're not going to generate revenue, significant revenue for many, many years, it's a challenge. And I think that's another way of looking at this, where in terms of ag tech and the solutions that you're referring to, most of them, I would say the vast majority of them, those solutions don't have to wait more than a year or two, right, before revenue or even profit. No. And we're going to see more and more companies adjusting their business model so that they're generating profit, in the next year or 2 years. If a year ago it would have been 5 years.
And I just a concluding thought, just going back to that Finnish kind of vertical farm doing trees. If the UK government's ever going to make its tree target, there's no way the existing UK tree growers, nurseries, are ever going to be able to supply the amount of trees they need. But B, actually, it's the importance of the learning curve. And what's this idea of the learning curve that effectively is you get rollout production techniques, you can reduce the cost, and because you learn more, you end up getting that classic cost. That equation, you've seen it with solar power, solar panels, they've literally gone down like this. That's the curve. Why people are getting so excited about vertical farms is it's not blue sky stuff. There are vertical farms all around you. There will be soon vertical farms in supermarkets. The stuff's out there. It's pricey. And one of the reasons it's pricey is because they've got to try and work their way around the cost of energy. A lot of LED panels, and that energy is expensive, as we all know. But the learning curve kicks in. And that learning curve is going to kick in super fast in areas where you've got manufacturing or production output already on the ground, and people are engineers are just trying to figure out, how do I squeeze an extra bit of light, power, heat out of something at a lower cost. And when that learning curve kicks in, that's where the killer applications come. And what I think is important, going back to your point about timescales, is I think if a learning curve can start to have a material impact for a sector, so for instance vertical farming and LED display and LED lighting, within 5 years, then startups could absolutely make a killing. It's absolutely what happened with AWS in Amazon. Amazon basically put money into AWS. Within 5 years, the learning curve in terms of servers kicked in and the money started rolling in. Over 5 years, you're in trouble.
I think just to conclude here, energy is everything. It really is. Energy, from the biomaterials days of forest tree wood, and then coal and then fossil fuels, and now solar and wind and then wave. The cost of energy is coming down. It's going to continue to come down. Then we've got Moore's law, Metcalfe's law, Wang's law. We're going to have quantum computing. That's also inevitable. And 10-year time frame, we're going to have an unbelievable ability to produce food, produce beverages, produce trees, change our world through technology advancement. I mean, this is what it's all about. It's hard to see in the next year or two because humans just see what's right in front of us. When I talk about drones, drones, it's Jetsons. Not going to happen. That is happening. It's also inevitable. It's absolutely going to happen. And that's what's so exciting about all of this. And the ability to take a 10-year view, but not taking too much risk is really the key at the end of the day.
Absolutely.
Yeah,
And one of the most radical ideas out there is in 10, 15 years' time, there could be an abundance of energy. Could be, not guaranteed. But if that changes the dynamics of a lot of the food sector radically, drastically overnight. Okay, I think we've talked enough. Thanks very much, Paul. We'll make sure you go check out our website, futurefoodfinance.com. We've always got lots of articles, and we'll be having an article about that very same Finnish firm next week. Loads of good articles, exactly what we've been talking about on a regular basis, as well as lots of data and indices. So check it out, Future Food Finance. We'll be back in a couple of weeks' time. Eat well.
And sleep well.